Hello everyone, welcome to today's video. The market is showing a very interesting contradiction. On one hand, funding rates in the crypto market have turned negative, which is usually a signal for a short squeeze. But on the other hand, the US dollar index has strongly broken through the 100 level. It's like a tug-of-war between technicals and macro. Today, I'll take you through an in-depth analysis of who will win this battle and what signals we should watch next. Today's content is divided into 7 main parts. First, I'll show you the core contradiction in the current market. Then, we'll quickly review the key macro and crypto data. Next, we'll dive into the liquidity situation and 3 key signals to watch. After that, I'll present 3 possible scenarios for the future. Finally, we'll summarize the current situation and point out the indicators to keep an eye on next. Let's start with today's core contradiction. Technically, the funding rates for both Bitcoin and Ethereum have turned negative, a very strong signal for a short squeeze, meaning the market could see a rally soon. But at the same time, bad news came from the macro side. The US dollar index strongly broke through 100 and gold plummeted. This creates a sharp contrast. Technicals are bullish, macro is bearish. So, who will win this battle? That's the core question we'll explore today. Next, let's quickly go through the core data. First, the macro and commodity markets. The US dollar index is above 100.07, a very important psychological level. Its breakthrough usually means pressure on risk assets. You can see, both gold and crude oil fell sharply today, with gold down 3.2% and crude down 2.8%. This is the direct impact of a stronger dollar, putting significant pressure on market risk appetite. Now let's look at liquidity. The size of the on-RRP facility, a measure of market liquidity, plummeted by nearly $1 trillion. This indicates that the market's liquidity buffer is being rapidly consumed. Meanwhile, bank reserves remain below the $3 trillion warning line, and the Treasury's TGA account is still draining liquidity. Overall, the liquidity environment across the market is tightening, which is not a good sign. Now let's focus on the crypto market. Both Bitcoin and Ethereum saw significant drops today, especially Ethereum, which fell over 10%. But the most crucial data is here. Look, the funding rates for both Bitcoin and Ethereum have turned negative. What does this mean? It means short sellers in the market now have to pay funding fees to longs, which is usually a precursor to an impending short squeeze. Let's look at 2 more interesting data points. First, the BTC ETF saw a net inflow of $32 million on June 4th. While the amount is small, it ended months of net outflows, a symbolic signal. Second, the crypto fear and greed index has dropped to 16, entering the extreme fear zone, which is often a sign that the market is near a bottom. Interestingly, the VIX, the stock market's fear gauge, is very calm, remaining neutral. This suggests the current panic is mainly concentrated within the crypto market. To summarize the current liquidity situation, the rapid decline in on RRP means the market's liquidity buffer is being consumed. Bank reserves are persistently below the warning line, indicating banks aren't flush with cash. Combined with the Treasury continuously draining liquidity, the overall market liquidity is tight. My personal judgment is that the market's safety cushion is thinning, which will amplify the impact of any future market moves. Next, let's look at the 3 most important signals today. The first, and strongest signal, is that the short squeeze signal has been triggered. Funding rates for both Bitcoin and Ethereum turned negative simultaneously, a historically very strong bullish signal. My statistics show that when this happens, if prices can stabilize and start rising, the probability of a short squeeze in the coming days exceeds 70%. So technically, the market is extremely bullish right now. The second signal is strong macro suppression. The US dollar index's strong break above 100 is a huge negative for all risk assets. Historically, whenever the dollar is above 100, stocks, commodities, and crypto don't perform well. So this signal creates significant uncertainty for the technical short squeeze. Whether the squeeze can succeed largely depends on whether the dollar can pull back next. Based on the above analysis, I've identified 3 possible scenarios for the market's future direction. The first, and in my view the most probable, is a successful short squeeze. If Bitcoin can hold above $62,000 and the dollar pulls back, the market will likely start a strong short squeeze rally, targeting $65,000 to $68,000. The second scenario is macro suppression prevailing. If the dollar stays above 100, prices will struggle to hold, possibly continuing to bottom out. The third is a technical bounce under extreme fear, a left-side buying opportunity. The most unusual aspect of today's market is the complete opposition of bullish and bearish signals. Technicals send a strong bullish signal, while macro gives a clear bearish signal. This state of contradiction means the market is at a crossroads, with bulls and bears locked in intense battle. The market may remain volatile until a direction becomes clear. In such times, our best strategy is to wait patiently and not jump to conclusions. Alright, let's summarize. The core driver of the current market is the tug-of-war between technicals and macro. I think the most likely path is that the market will first experience a period of volatile battle between bulls and bears, then choose a clear direction. What we need to do now is patiently wait for 2 key signals, either price stabilization plus a dollar pullback, or continued dollar strength suppressing prices. Finally, I'll list 3 indicators to focus on next. First, can Bitcoin hold above the key psychological level of $60,000? Second, can the US dollar index fall back below 100? Third, can ETF inflows be sustained? These 3 signals will directly determine the market's next move. I will continue to track these data for everyone and share my views in a timely manner. This sentence stuck with me. It accurately summarizes the core contradiction in the current market. Technicals and macro are like 2 forces in a tug-of-war. Whichever is stronger will dictate the market's direction. Understanding this helps us better grasp the current market pulse. You taste it carefully. This historical pattern is an important basis for our judgment of a short squeeze. A negative funding rate is just the first step. The key is to see if prices can stabilize and rise. Once both conditions are met, we are likely to see a rapid short squeeze rally in the coming days. This sentence is spot on. The current market is in such an extremely contradictory state. As investors, we don't need to force a side in the contradiction. Instead, we should patiently wait for the market to make its own choice. Once the direction is clear, it's not too late for us to take action. At the end of the video, I must emphasize the disclaimer. All the analysis and views I share today are just my personal interpretations based on public data and historical patterns, for your reference only, and by no means constitute any investment advice. The market has risks, and investment requires caution. Everyone must think independently and make their own judgments. For more in-depth analysis, follow my official account. See you next time.